Hi guys, how are you? Mine this one Titanium. Welcome back to Real Macroeconomics and Investing. Patreon.com/Real Macro. Come on down and subscribe. Okay, so we're building an economy from scratch. I'm trying to uh, explain it in a very simple way as to how to understand economics, and at least how I view economics, so we can speak the same language when you watch my videos. So, in this video, we're going to talk a little bit about the Fed. Okay, um, a lot of misconception out there about the Fed, and you know, I think it's time to start talking about it at this stage. All right, so the Fed is what? It's independent within government, not of government. Okay, independent within government. So Congress appoints the chairman. Profits are remitted back to Treasury. Um, their dual mandate is maximum employment with price stability, and they used to at least do this, achieve these goals um, using interest rates, short-term interest rates. Okay, that's that's what the Fed is, right? It's also a clearinghouse above everything else. What it mostly is there for, it's a clearinghouse for the banking sector um, to clear payments. Now, the Fed is a lending institution. Okay, it doesn't cannot create deficits. Deficits can only come from Congress or now, I guess, from the president as well by executive order. No one challenged it, so I guess the president can do that too. Um, but it's a lending, you know, uh, institution. Okay, it's not a deficit institution. So when we're talking about QE, which is something relatively new, right? It's 10 years old now, but it's still new. In that case, it doesn't increase deficits. Okay, all it does is asset swap. It swaps dollars for dollars. The $1 has a coupon, which is a bond, and it takes that onto its balance sheet from the savers. Oops, whoa, chill out there, big guy. 1 second. All right. It takes bonds back onto its balance sheet, and in exchange, it gives cash. Okay, so $100 of bond is going to be exchanged for $100 of cash. Okay, you're not richer, you're not poorer. It's just an asset swap. Now, on the surface, you would say, well, nobody's richer, nobody's poorer. It's placebo, right? That's what Warren Moser likes to say. It's placebo. It's nothing. Well, that's not true. uh, because indirectly it's funding government. That's one, okay, which is illegal. Um, but it found a loophole. Two, it increases the money supply, okay, and reduces the amount of bonds available, okay. And a simple law of demand, okay, when there's less bonds and more cash, what happens to the price of the remaining bonds, right? The remaining bonds, the price goes up. Okay? And as price goes up, as we talked about before, the yield on those bonds goes down. So is that placebo? No, that's not placebo. Now remember, I told you before, earlier, that the Fed was trying to achieve price stability and maximum employment using short-term interest rates. Well, with QE, it could buy anything on the yield curve, all the way out to 30 years. So QE gives the Fed a new tool, as they call it, to buy in any maturity date, where previously they could not. Okay, they can influence where interest rates go in the open market, in the free market. So why did I say that it's a loophole to fund government? Well, as you've seen recently, right, we've increased deficits, which is, like I said before, right, it's an increase of bonds available, okay? Uh, when you're increasing deficits, you're increasing the amount of bonds available. Um, well, when the Fed is buying, well, let's talk about it this way: 4 trillion in bond issuance by the government, right? The deficit spent was met by $4 trillion, okay, by the Fed expanding its balance sheet. So you can see that the money is going back into funding government indirectly, just a loophole. Now, is it all of the $4 trillion going to treasuries? The answer is no. So let's take a look at some of the programs that were introduced. Okay, and here's the programs. Okay, the CPFF, the PMCCF, the TALF, the SMCCF, the MSBLP. Yeah, okay, okay. It's a funding facility, a credit facility, a loan facility. I can go over this, and it would take quite a while to explain each and every one of them. But you can go to the website and you can look these up when they were issued, what they're meant for. Okay, go back, pause the video, and take a look at it. So, one notable purchase is that they're buying junk bonds, for example. Okay, that's not treasuries, right? They're junk bonds. Well, when you have the Fed coming in and exchanging bonds for cash in the junk bond market, what does that do to risk? Right? There's always a buyer there that reduces risk. This is what when we're saying there's liquidity, and liquidity is boosting up asset prices. Well, if you know that there's somebody out there that's always going to buy it no matter what, you don't much care about the risk, right? So you will take on riskier bets, if you will, uh, when you know that the Fed is just going to buy it off of you at a higher price than what you paid for it. Okay, and that's problematic. You see, when you're trying to remove risk, risk is healthy. When you're trying to remove risk, you're actually increasing risk. Okay, uh, you know that's the problem with with socialism. If you keep and I'm not saying we shouldn't do socialism. That has nothing to do with it. But if you just keep giving people money, that demoralizes them from going out and making money and being innovative and being productive, right? So what happens to that economy? It starts to suffer over the course of time. People get lazy. Well, it's the same thing with risk in junk bonds, right? If you know there's going to be uh, a buyer, well, why are you going to sit here and do your homework? Just go out and buy it, and everything is fine, and let the Fed buy it. Well, over time, when it snaps, okay, all the fun, all the Fed bond buying, junk bond buying in the world is not going to save you. Okay, it's the law of diminishing returns. Right? There's only so many of them available. There's only so much cash that you can flood the system with. Okay, before the cash, abundance starts to not really matter that much. People don't have such a high demand for your dollar anymore because they're not that hard to acquire. That's the law of diminishing returns. That's the risk, right, over the course of time. I don't want to get too philosophical about this, but it's just the way it is. Okay, that stability is inherently destabilizing, just the way it is. All right, so we have all these new lending facilities, and now some of these loans they're going to be defaulted on, and again, the Fed does not make loans that we know are going to be forgiven or defaulted on, right? So now they've created SPV. What's a SPV? It's a special purpose vehicle. What does that mean? Well, when let's say an airline, okay, they want to put their airplanes under a different company and then lease them back to the parent company, and the parent company is not doing all that well. Well, they use SPVs to assure that if the parent company goes bankrupt, then they're going to be saved um, uh, in that case. That's an SPV, right? So that's what has been created now by the Fed, by the Treasury, to backstop the losses for the Fed. So while the Fed is buying junk bonds, okay, and making loans into the productive economy only to forgive those loans in the future at some point, and maybe some of these companies here are going to start to fail. Um, and you're doing this knowingly, right, that they're going to, blow up and be forgiven or whatever. Well, somebody's got to, pay the Fed, right? Because again, it doesn't have the authority to go out and deficit spend or make loans that they know are going to be not repaid. What's beautiful about this is that it offsets the deficit, okay? Because if Treasury is going to fund those losses, that's got to come from the deficit. You see what I'm saying? So it masks the deficits to a future point in time. And it's, brilliant if you think about it and if you want to scam somebody, right? Oh no, no, it's just 4 trillion in deficits. Well, no, you're making loans that you're going to forgive or they're going to blow up and then you're going to have to pay for it at some point in the future, right? It's always about kicking the can down the road. That's what politics is about. And that's what political economic theory is, right? It's incubator. It works great on a piece of paper until reality hits. For example, it was great to give $2 trillion of tax cuts in 2017 because the economy was going to skyrocket, you know, to the moon until COVID came along, and now you have to spend 4 trillion. 2 trillion is not enough anymore. Now you got to go to 4 trillion. Remember, deficits in 2008 were 10% of GDP back then, which was about $1 trillion. Now we're up 25% of GDP. So what's the next one? Are we going to be the next Greece? 100% of GDP? 50, 75, 100? What? You see the problem with kicking something down, kicking the can down the road. I can't even speak, but anyway, kicking the can down the road after a while catches up with you. So let me try to put it all together because it's a little bit complicated, and unless you draw it out, I think it's going to be very difficult for people to understand. So you have the government issuing a bond, and we haven't talked about what happens when a bond is issued, but it's auctioned off to primary dealers, and then the primary dealers buy these bonds, and then they sell them off to the secondary dealers, and then the secondary dealers give them to their customers and whatever, right? And that's the way it works. So you have government issuing bonds. The Fed auctions them off to the banking system. Okay, they bid on it, whatever the interest rate is, and then um, once they're done issuing those bonds, right, which is basically an asset classes over here, bonds, right here. Okay, the Fed goes out and buys bonds anywhere along the entire spectrum of the yield curve, buys them back, okay, buys them back, and it gives the bondholders in exchange cash, right, without a coupon, gives them cash. So that's QE. Now the new QE is we're going to go out and we're going to buy junk bonds. We're going to buy junk bonds. And in return for those junk bonds that the Fed is going to purchase, they're going to give them cash, right? They're going to give them cash, knowing that they're going to probably default. It's the same thing with, giving loans to small businesses that they know they're going to forgive, right? So what happens in this case? Well, now the Fed has to be funded by Treasury, and then Treasury is going to give those uh, those dollars to the Fed to make them whole, and that will increase deficits. If it increases deficits, which means they're going to have to issue more bonds, which means the QE is going to have to increase to keep interest rates low, and the cycle keeps on repeating. A lot of financial wizardry, or I would call it fuckery, okay, that is going on. In the end of the day, okay, what's happening in the productive economy? Right? Not much. Not much. Not much at all. Well, $600 checks do help, of course, and they should be issued. I don't have a problem with that, short term, or $300 or whatever, 400. I don't know what it, each state does or whatever. That's helpful, and it should be done. That's okay. It's not a solution, right? The solution is you want people to be productive, you want people to be innovative, you want them to be efficient, and you want them to keep growing the economy. All this fuckery that is going on all over God's creation here, okay, will, you know, make up a spreadsheet, moves numbers around, increase them, have no value behind them, just keep, you know, making things more complicated, is not going to change the fundamental economy. Okay, it might appear so, but it doesn't. All right, so let me clear this out. So all these lending facilities here, let me move this over. All these lending facilities here, okay, they're great. They make a lot of sense on the surface, but when you look closely, um, they don't do a whole hell of a lot. All it does is create zombie companies. What's a zombie company? A zombie company is a company that should not be around. It should either go bankrupt or be taken over or just collapse. This allows the other stronger companies to thrive. It allows for new investments, new ideas, new startups, new companies to come in and fill that void. Okay, economies recover on their own. They don't recover because somebody made a very complex spreadsheet. Now, having said that, I'm all for staving off fear, right? Fear makes things worse. So I'm all for that to a point. There's always limits to everything. If you go to Ukraine, for example, did they receive any stimulus check? Nope. Did they get any funding for their government programs? Nope. Okay. So why are they doing fairly okay and the United States is not? Because in the Ukraine, they are used to risk. They prepare for risk. Okay, so when the bad times come, they're ready. They have something in the background, savings or whatever. They've prepared for what is happening. Here, in a socialist Western world that we have become, there's no risk. So nobody's ever prepared. If we're not going to the mall every single day, okay, that's a problem. That's that's a big recession. That's a depression if we're not going to the mall every day. And why do I say that? Well, 70% of GDP is consumption. That's what it is. And if you're not consuming 70% of GDP and we're exporting jobs, well, what's going to happen to the economy? You see, we'll start to contract. So the bright idea is, well, we'll just print up money and hand it out and let people go out and buy stuff. Okay, you think that's going to work? We'll backstop risk for the junk bond market. We'll backstop risk for businesses. We'll backstop risk. We'll do all these things. And this is under the gist of for the people, right? Everything is for the people, for the people. Right. But yeah, but you're putting liabilities on the shoulders of the people when you're doing that. It's not like this has not been tried before. I can understand countries that don't understand economics that go out and do this, right? Venezuela, Zimbabwe, there's 145 of them. Most recently, Lebanon. Okay, did it work? No. It did not work. It's not going to work. It never works. If it worked, Venezuela would be an economic superpower. Argentina, right? So this is why I think these videos are important. Doesn't mean we cannot deficit spend. It's not what I'm saying. You can to an extent, right? There's limits to everything. The fact that you can do something doesn't mean you should, right? That's a famous Edward Delzio saying. Just because you can, it doesn't mean you should, right? You can jump out of an airplane without a parachute. You got to worry about the landing. Anyway, so I don't want to get too much into this, but I know it's idealistic in what I am saying, and I understand that the politics behind it all, they're gonna do whatever politicians do, right? Try to pretend everything is fine and this is for the people and blah blah blah. Again, it's one thing during a shutdown to give stimulus checks, which they're not stimulus, but let's call them stimulus check, to give checks to people to sustain them. It's one thing to do that, and it's another thing to go out, manipulate bonds, um, and force stock prices higher. And this is the last point I want to make about QE and the Fed. When you look at the interest rate, and there's an interest rate on bonds, and then there's an earnings yield, okay, on stocks. When the bond yield falls, and let's say that the earnings yield remains at the same level, well, what happens? Well, money chases yield, okay? That makes stocks more appealing. If the earnings yield of a stock is 5%, and you can go out and buy a bond for 0%, okay? What are you going to go buy? A bond or a stock that's going to give you 5%, right? You're going to go buy a stock. So the earnings yield starts to drop because people are buying more and more stocks with an S. So let me give you an example, a live example. A 10 year is going to give you 0.68%. And when you look at the stock's earning yield, which stocks are riskier, is at 3.58%. Okay, what are you going to buy? You're going to buy stocks, right? And this is why Buffett says that if interest rates remain low, stocks are cheap, right? He said that before. So does the rise in the stock market reflect fundamentals? Absolutely not, right? Of course it doesn't. But again, it's this QE that is affecting bond yields, which affects in turn stock yield. Okay, stock's earnings yield. Well, again, when you are decreasing the amount of bonds available and you're increasing the amount of cash, and this is why I say they're liquefying bonds to cash, and you have more dollars, okay, and less bonds, okay, prices are going to go up, yields are going to come down, which is going to push down the yields on the stock market, but push the prices up on the stock market. Okay, is that placebo? No, absolutely not. And if you see the last time that earnings yields came so low, we hit a dot-com bubble, right? A lot of companies with no earnings. Now, since 2008, we're going lower and lower, not because there's so many companies that um, are not making earnings, but rather because the interest rates on the 10-year are so much lower, thereby making stocks, although riskier, making stocks more appealing, forcing riskier investment. So when you're looking at corporate earnings over the course of the last decade, right? Well, since 2012, right? Last 8 years, they've been flat. Okay, hovering around $2 trillion per quarter. Okay, they've been flat. And now, after the lockdown, naturally, they're going to come down, and it's testing this support area here. Okay, so it's 1.5 trillion now. All right, so you see a drop in corporate earnings, and you're seeing a rise in stock markets. Well, why do you think that is? Right? It's not QE. It's placebo. Really? Mm, I don't think it's placebo. So you see why a lot of people bitch about the Fed, right? Uh, It's it's complicated. It's not very simple. Okay, it's what politicians want. It's saying that the Fed chair is not political. I think is just nonsense. Even though they say they're not, they are. Let's be honest, okay? And all this MMT stuff that we can print to infinity. Don't worry about it. Give $1,000 to everybody. Give $2,000 to everybody. Give $10,000. There's always limits to things, right? All this MMT stuff sounds great. It really does. But in the end of the day, you have to get people to go out, work, innovate, be efficient, produce, right? Blood, sweat, and tears. That's what it comes down to. Sure, you're going to see the stock market go up, but the more money you give them, the more they're going to want. Law of diminishing returns. Eventually, when the money stops, what are you going to do? You're going to see the market come down. Okay? Um, it's just the way it works. It's just the mechanics of trading, right? If you're going to give me, as a fund manager, more money to go out and invest, well, I have to invest it. I have to go out and buy things to invest it for you. And I'm going to look for the best yield that's available. And if stocks are better than bonds, then I'm going to go out and buy stocks. If bonds are better than stocks, then I'll go out and buy, bonds. If Greek debt is going to give me a higher interest rate than an American debt, then I'll go buy Greek debt, right? Or Italian. Italian debt now I think is down to 1.2% or something on the 10-year. Okay, unheard of, unheard of. But I can do that because I know the ECB will come in and save me, just like the Fed, right? So again, reducing risk sounds good, might feel good, but over the course of time, it becomes problematic because the more candy you give, the more candy they're going to want, and eventually you end up in this place where candy you know, doesn't save the day anymore, and that's when the real problems begin. All right, so I hope this made a little bit of sense. It's a very complex topic. I don't even think I did it justice in this 27 minutes, 30 minutes, whatever video it is. I tried to include as much as I could. We'll talk a little bit more about it when I introduce banking, but I wanted to give you an idea uh, what's going on with the Fed and all these programs. And in case you want to look them up, here they are again. Okay, you can go out and look at them. All right. Hopefully, this explained a little bit why the stock market is going up when the economy is tanking, why it's problematic, and returning to the mean at some point is almost imminent, and why I say we're running in the dark, towards a cliff. We just don't know where the cliff is. Right. This is why I say these things. No government can print value for a currency, right? You can't just print productivity, efficiency, and innovation. You can't do it, right? People have to actually go out and do it. And we understand the realities between political economic theory and reality. They're not the same thing. And just because you can do something doesn't mean you should, right? As Edward would say. So, you know, keep this in mind. Think about it. If you have any questions, post them below and we can talk about them. Okay? So that's it. Again, thank you for um, uh, watching this video, coming down and supporting me, and also come down and subscribe to patreon.com/real macro. Okay, real macro. Come on down. All right, guys, take care. Bye bye.